turning to carried interest, and Hadley touched on this earlier, but I'm going to dig into it a bit more detail and do a bit of a refresher. But really, carry continues to be a material component of our value proposition, and we believe it is still underestimated. We earn our carry from two sources. The first of these we call our legacy funds. These are the funds that were raised before the separate listing of Brookfield Asset Management, i.e. funds that were raised before the end of 2022. For those funds, we earn 100% of the carried interest, 100%, but we also incur 100% of the costs. So this is a legacy, this is a cash flow stream from funds raised before 2023 that will run off to zero over time, and in that time, we will earn a combined margin of 65%. The second stream is what we call the royalty. This is against funds raised from the start of 2023 onwards, where we have a perpetual right to earn 33% of the carry, and we incur zero costs. This is effectively a perpetual royalty at a 100% margin. Now, how that carry makes its way into income is also worth refreshing. We follow a European model for the waterfall as how it comes into income. That means we realize carry on a fund-by-fund basis, which is different to an American waterfall, which realizes carry on an investment-by-investment basis. We follow the life cycle set out on the page. First, we invest the capital of a fund. We then sell assets and return all of that capital to our clients. We work our way through the preferred return across the entire fund. And once that preferred return has been delivered, we start to realize carry on every incremental dollar. Now, over the life of a fund, the carry you realize under a European and American waterfall is exactly the same. But under our approach, that recognition is deferred to later in the life of the fund. This approach ensures strong alignment of interest with our clients. We do not realize any carry until the risk of clawback is very remote. It de-risks future carry recognition, and if you think about how you work through that waterfall, it also dramatically increases your line of sight to carry as you work through the process. And we believe that our carried interest is now very much at an inflection point. The scale, diversification, and number of the funds that we have right now is increasing dramatically the carry potential to Brookfield Corporation. Second, transaction activity, as you've seen in our results and recent achievements, has dramatically increased. That means we're returning more capital to our clients, which is going to result in larger, more stable, and consistent stream of carried interest coming in cash and into income for the corporation. To put that into numbers, over the next 10 years, we expect the net realized carried interest to Brookfield Corporation to be $25 billion. It was just $4 billion for the last 10 years. We expect to be $25 billion in the next 10 years. If we narrow that time frame down even more to just the next 3 years, it's $6 billion of net realized carried interest that we expect to realize in cash and into income over that period. Two-thirds of the carry, two-thirds of the $6 billion, will come from 7 funds, just 7 funds that have a proven track record and on aggregate have already returned 90% of their capital. So it's that increased line of sight that's giving us the confidence in our ability to recognize this carry into income over the plan period. And as I mentioned, the carry potential of the organization is increasing significantly. Carry eligible capital is scaling to $575 billion over the next 5 years. As we execute our plans, buy for value, and create value in our investments, annual generated carried interest is scaling to $7 billion 5 years from now. And realized carried interest is increasing up to $6 billion on a gross basis. Now, if you look at the plan 5 years from now, you can see the gap between the gross and the net is widening out. What that is in practice is those legacy funds running off and the royalty funds starting to be the more meaningful contributor to carried interest for the corporation in the future. Now, we value this carried interest today at $34 billion. The valuation approach we have here is consistent with how we've shown it in the past. The punchline I would really have on carry is it's very meaningful to our value proposition. It will generate significant cash and income for the business. If I pull all of that together and look at the overall growth profile that we have from the asset management business, distributable earnings from BAM, that is just our share of the growth of Brookfield Asset Management, 18% CAGR. Distributable earnings from our direct investments, they're growing, but our capital at risk is coming down as we reduce our investment. And then the benefit and the realization of carried interest into income culminates in a 20% compound annual growth rate from our asset management business over the next 5 years.